Welcome to The Explainer. Look, if you're trying to cut through all the market noise and really get a grip on the structural shifts happening in modern finance, well, you're in exactly the right place. Today, we're running through a professional analyst briefing on Robinhood's first quarter 2026 earnings. Now, for years, the broader market just kind of viewed Robinhood through this lens of the post-pandemic meme stock trading hangover, right? But today, we're throwing out those old narratives and looking strictly at the hard data to see exactly how they're escaping that legacy. We're going to break down their structural revenue drivers, evaluate the true sustainability of these massive recent deposit inflows, and really understand how they're making this huge leap from an active retail trading app to a comprehensive global financial ecosystem.
Quick reminder before we jump into the numbers, this video is for educational purposes and not financial advice.
Okay, let's dive into this. Here's the bottom line up front for our briefing today. We're covering 5 key areas. First, Q1 2026 top-line metrics. Second, key revenue growth drivers. Third, net deposit sustainability. Fourth, gold subscriber economics. And finally, future catalysts and outlook.
Number 1. Q1 2026 top-line metrics. Let's start right at the top of the income statement.
So, Robinhood delivered total net revenues of $1.7 billion for the first quarter of 2026. That is a really solid 15% growth year over year. Think about the current macro environment for a second. With all the interest rate uncertainty and obvious retail fatigue that's been pressuring legacy brokerages, putting up a 15% top-line expansion, that's a massive signal of operational leverage. And at the exact same time, they pushed diluted earnings per share up 3% to 38 cents. Achieving double-digit revenue growth while still actually expanding the bottom line, it points to a hyper-disciplined approach to capital allocation. But hey, as analysts, we know the big aggregate headline number only tells a fraction of the story. $1 billion in revenue is great, but for us institutional stakeholders, the real question is how they actually engineered that growth and whether those revenue streams are truly durable over the long haul.
Number 2. Key revenue growth drivers. Let's get into the actual mechanics of this growth.
And this brilliantly illustrates the story here. The shifting revenue mix inside Robinhood is honestly a fascinating story of maturation. Transaction-based revenue, still the biggest piece of the pie at $623 million, growing at a fairly modest 7%. But the real story of margin expansion lives in the non-trading segments. Net interest revenues climbed an impressive 24% to $359 million. That's mostly driven by disciplined management of interest-earning assets and just a higher overall balance of customer cash sitting on the platform. But check this out. Even more striking is the other revenues bucket, which absolutely surged 57% to $85 million. The main engine revving up that specific growth vector, Robinhood Gold subscriptions. This whole shift is a highly deliberate move away from just relying on pure transactions, moving steadily toward recurring yield and subscription models.
Now, we really need to double-click on that transaction revenue bucket for a second, because beneath that aggregate 7% growth, there is some massive internal volatility that absolutely requires institutional attention. What really stood out to us here is how Robinhood absorbed a staggering 47% year-over-year drop in crypto revenues. It fell all the way down to $134 million. Just a few years ago, a crypto contraction of that magnitude would have completely derailed their entire quarter. But their internal diversification acted as this massive hedge. Event contracts surged an unbelievable 320%, generating $147 million. That practically offset the crypto decline all on its own. Combine that incredibly specific growth with a super healthy 46% jump in equities revenue, and we are looking at a trading desk that is actively, successfully neutralizing its historical dependency on those wildly cyclical crypto markets.
Moving on to number 3, net deposit sustainability. Because look, generating trading fees is one thing, but long-term wealth management requires securing actual sticky assets. In the first quarter alone, Robinhood pulled in roughly $18 billion in net deposits. To put that into strict analytical perspective, that translates to a massive 22% annualized growth rate relative to their total platform assets at the end of 2025. And if we zoom out slightly, over the trailing 12 months, they've brought in nearly $68 billion in net new assets. For institutional observers, the sheer velocity of this asset gathering is just impossible to ignore. Pulling in capital at this rate puts their organic growth velocity right alongside, and honestly, in some metrics ahead of, the legacy titans in the wealth management space. So the critical question for the market isn't whether Robinhood can acquire users anymore. It's all about the quality and longevity of the capital those users are bringing in.
Naturally, management is pointing straight at their accelerated product pipeline as the main catalyst here. Chief Financial Officer Shiv Verma emphasized exactly this on the recent earnings call. He stated, "In Q1, customers remained engaged and rapidly adopted new products, leading to a 20% plus annualized net deposit growth rate." So leadership's core thesis is that these inflows aren't some lucky accident. They are the direct mathematical result of expanding the platform's utility. But, as objective analysts, we've got to parse the data a little further. We need to figure out if these deposits are simply hot money chasing a temporary promotional yield, or if they represent sticky, structural assets taking up permanent residence on the platform.
Now, what's really interesting about this slide is how we weigh the different types of capital flowing into the system. There is undoubtedly a clear promotional effect happening here. Robinhood is still being super aggressive with account transfer bonuses, driving $5.9 billion in incoming ACATS transfers against just $2.2 billion outgoing, capturing competitors' accounts at nearly a 3-to-1 ratio. Fantastic net positive. But promotional money is, by definition, transient capital, right? It can leave exactly as quickly as it arrived the second a competitor offers a slightly better bonus. However, the real structural story, the one that fundamentally alters their valuation multiple, is in retirement. Robinhood's retirement assets under custody shot up an incredible 90% year over year to a record $27.4 billion. Retirement accounts are notoriously sticky. They represent this massive behavioral shift from day trading to generational planning. Once capital lands in an IRA, it rarely leaves quickly.
Which brings us to number 4, Gold subscriber economics, because this premium tier is the primary anchor for those sustainable assets.
If you're wondering why Robinhood is so aggressively prioritizing its premium Gold tier, well, the unit economics tell the whole story. The divergence in behavior here is massive. Compared to a standard funded customer, the average Gold subscriber holds 5 times the assets under custody. 5 times. They also compound their wealth by depositing money 20% faster, and crucially, they are 3.3 times more likely to adopt a retirement account. In the first quarter alone, the company successfully added 1.2 million Gold subscribers year over year, which brings that total base to a record 4.3 million. This is just a highly lucrative, deeply engaged cohort that fundamentally upgrades the lifetime value calculus for the entire organization.
So how exactly do you keep 4.3 million high-net-worth retail users from migrating back to a legacy broker? You don't just offer isolated little perks. You build an interconnected psychological moat. The strategy relies on this aggressive web of financial incentives. They're offering a highly disruptive 3% match on IRA contributions, a 3.35% APY on uninvested cash sweeps, entirely free margin on your first $1,000, and a flat 3% cashback on the new Gold card. Let's be real. Breaking up with a broker is already a huge administrative headache, but breaking up with a broker that is actively paying you a 3% match to fund your retirement and yielding top-of-market rates on your idle cash, that just becomes financially irrational. Robinhood is effectively paying a premium acquisition cost up front to secure institutional-grade capital. They are betting heavily that the behavioral lock-in, the long-term asset management fees, and the net interest spread will completely dwarf those initial marketing expenses.
Number 5, future catalysts and outlook. Let's wrap up by assessing the forward-looking risks and opportunities as we look deeper into 2026.
Let's move to and see how this builds. CEO Vlad Tenev frequently refers to their corporate strategy as relying on relentless product velocity. And honestly, the pacing of their development cycle over the past few quarters has been nothing short of remarkable for a regulated financial entity. Just over a few months, they engineered and shipped multi-currency wallets for international users, integrated complementary tax filing software, launched custodial and trust accounts, and deployed the Robinhood Platinum Card. The strategic imperative here is clear: relentlessly fill out every single conceivable gap in the product suite. The ultimate endgame is to create a fully enclosed ecosystem where a user literally never encounters a functional, financial, or administrative reason to move their capital to a traditional legacy institution.
Now, executing an aggressive product pipeline of that magnitude definitely requires substantial capital expenditure. Consequently, Robinhood increased its 2026 adjusted operating expense outlook to a range of $2.7 billion to $2.825 billion. For institutional investors evaluating potential margin compression, it is very notable that this updated guidance actually includes a specific $100 million allocation to build and support the user interface for a joint venture known as Trump Accounts. Working alongside BNY, Robinhood is acting strictly as the underlying broker here, building a standalone application for this initiative. According to the corporate filings, this specific contract operates entirely on a cost-plus basis. From a risk management perspective, that cost-plus structure essentially de-risks the capital outlay. It guarantees Robinhood a small margin over their $100 million development and operational costs, meaning they are functioning purely as a financial infrastructure provider in this deal.
Look, Robinhood has successfully navigated a really difficult post-pandemic trading environment by aggressively pivoting into structural, sticky wealth management. Sitting on $307 billion in total platform assets under custody and a rapidly growing, highly monetizable base of 4.3 million gold users, the mechanics of their turnaround are objectively working. They are capturing assets at a velocity that absolutely demands attention. So the crucial point is, and the final provocative question we have to leave you with as analysts and stakeholders is this: can Robinhood maintain this specific accelerated pace of asset acquisition to truly evolve from an active retail trading app into a comprehensive global financial ecosystem? The data from the first quarter suggests they absolutely have the operational momentum, but the flawless execution of their 2026 product pipeline is going to be the ultimate test of their staying power.
Like and subscribe for more videos.